Welcome to the 3 Edge Week in Review for the week of May 10th, 2021. I'm Fritz Folts, Chief Investment Strategist here at 3 Edge, and I'm joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at 3 Edge Asset Management. Today, along with a brief update on the global capital markets, Steve and I will be discussing the topic of inflation, and in particular, we'll focus on money supply and money velocity. But first, a brief market update. Equity markets got quite a scare earlier this week when the Bureau of Labor Statistics reported that the Consumer Price Index, or CPI, for April rose 4.2% over the prior year. Expectations were for a reading of 3.6%, and this larger than expected increase in CPI played into investors' fears that the U.S. economy may overheat, causing prices to rise and sparking increased inflation, thereby potentially forcing the Fed to begin to normalize monetary policy sooner than they are currently indicating. The elevated CPI report triggered the largest decline in equities in almost 3 months. However, markets bounced back on Thursday and Friday as investors seemed to shift their focus once again towards the benefits of what is expected to be a strong economic rebound and away from inflation worries, at least for now. So, Steve, we have heard the Fed say time and again that they believe that any increase in inflation should be, one, expected as a result of the U.S. economy emerging from the pandemic, and two, temporary, or as they like to say, transitory. So do you agree with the Fed here? Is inflation most likely to be temporary? And how long is temporary anyway?
Well, Fritz, what you said is true. In the real world, inflation is rising rapidly. As you mentioned, it's over 4% as measured by the Consumer Price Index. And then just after that, we got a report that producer price inflation is up over 6%. And we know that producer price inflation leads consumer price inflation. So we think that inflation might be stickier than what the Fed is broadcasting. And part of their statement is not so much that they're trying to be brilliant forecasters, but they're trying to influence inflationary expectations. If they convince people that it's transitory and they hold the inflationary expectations at their target level, they're hoping that that influence will cause a result. Our concern is that it might be stickier. It most likely will be stickier than they think. And transitory might be a longer period than they think. And that in some ways, it's the mirror image of what happened all the way back in 1981, where for years and years, people believed inflation was here to stay and that any dip in inflation would be transitory and inflation was just getting worse and worse. And that happened for years leading up to the early 1980s. And we know that that finally reversed. And we might be seeing the mirror image now where for years and years people said, no, inflation is just getting less and less and any blip might be temporary. Well, this could be that sea change.
Great. All right. So let's go back in time again, but this time not quite so far, but back to 2008 and the financial crisis. And we remember well that it seemed like everybody was saying that, oh my gosh, there's all this monetary stimulus and that's intended to bail out the economy, which was, it was a crisis and that was probably the right thing to do. But people were very concerned that this is going to be not only inflation, but runaway inflation. And in the end, we didn't get any of that.
So
is this a distinctly different period than then? And how would we know if that were the case?
Well, I think it is. Now, if we think about what happened then, during the financial crisis of 2008, we actually had some deflation, and the Fed was deathly afraid of that. And so they tried as hard as they could by creating monetary stimulus, try to rescue the economy and try to intentionally cause inflation. And they began the increase in money supply. And when that happened, like you said, Fritz, people thought, oh, this is dangerous. This is going to cause so much inflation, and the inflation never came. And as you can see on the chart, we see how money supply has been increasing for quite some time, and certainly through that period in the financial crisis of 2008. But the reason why we didn't get the inflation is that when you increased money supply, it increases the potential for inflation. But if there's limited demand at that time, then what's happening is the Fed is just pushing on a string. And they're trying to create the inflation by creating all this money supply. But if the money just sits there and doesn't change hands, you don't get the actual inflation. You have the potential inflation, you don't get the actual inflation. Now that changing of hands is technically called money velocity. Money velocity is the speed at which money changes hands in the real economy. You can have all the money in the world, but if the money just sits there, it's not going to cause the inflation. So now we're going to look at the next chart, which shows not just the money supply, but also the money velocity. Mm-hmm. And what you can see is for many years now, money velocity is plunging. Now, before this period, money velocity was very stable for decades. And then all of a sudden, over the last several years, we've seen money velocity plummet. And this is what I mean by as the Fed tried to stimulate the economy and create inflation, they created big increases in money supplied. You can see more recently it's accelerating, but we haven't got the inflation yet because a lot of that money stayed in the system, didn't change hands, money velocity is very low. And so what did it do instead? It inflated asset prices, and that's why the stock market is at an all-time record. However, money velocity doesn't need to go down forever, and if it just goes back to normal, we could have a tremendous pressure on inflation. And money velocity is very much triggered by psychology. Ever since COVID, we have the potential for a big regime shift or big change in psychology where, unlike before COVID, when all the stimulus was from the central bank and the money stayed in the system, ever since COVID, we now have had fiscal stimulus. We've had the government, which can do something the Fed can't do. The Fed can only lend. The government can actually spend, put the money more directly into the hands of people and of the real economy. And this is the big shift that we haven't had. This is the missing link. This is the key that can unlock inflation. And we're now just seeing this happen in real time. This is why we think inflation could be stickier than what the Fed is telling everyone.
Wow, very interesting. So let's just take that one step further then. So if we do continue down this road and we do get this regime shift, then ultimately, what does that mean in terms of investment strategy for such an environment?
So this regime shift that we believe was triggered by the COVID in the post-COVID period has big implications. When you have a regime shift, it's like changing the rules of the game. And before such a shift, a certain investment strategy might have really been successful and outperformed. After such a shift, the rules of the game change, and whatever worked before is unlikely to work after the regime shift. It's a new set of rules, new set of strategies that can work. So we believe we're in that new world now, and that'll become more and more obvious as this unfolds. And so what we're looking at is, if we take equities to start, before the regime shift, the economy was growing not so fast. It was growing more slowly than people would have liked. So people were favoring companies that could grow their earnings regardless of how slow the economy was growing. And those were largely growth in tech stocks. And because a lot of those companies were promising future earnings way down the road, when you had low interest rates, you discounted those future earnings with a lower discount rate, and they became more valuable. Now, after the regime shift, we have a period where now the real economy is picking up. The real economy can grow. No need to go out of your way to pay high prices for companies that can grow without the economy. You might as well take the better priced companies that can grow with the economy. So that's a shift from growth equities to value equities. Now, the US equity index, the S&P 500, has a big concentration of growth equities within it. International equities, like in Europe and in Asia and other places, have bigger concentrations of value-oriented companies. So we think this will be a regime shift that will go from US outperformance to international outperformance. Then finally, bonds have benefited greatly since 1981, when the big change in psychology happened and when inflation turned to disinflation. Now we have a situation where bonds will be less favored in the new regime. Inflation is the enemy of bonds. but inflation is the friend of real assets.
Excellent. Very, very helpful. So that will do it for us. Steve and I will be back next week with another edition of the 3Edge Week in Review video. And remember that all of our videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. You can subscribe to our 3Edge YouTube channel in order to be notified as we release additional videos in the future. In addition, if you'd like to submit any questions, make suggestions for future topics, very much like to hear from you, and you can just send us an email at weekinreview, all one word, weekinreview at 3edgeam.com. And meantime, on behalf of everyone here at 3Edge, we hope that you have a wonderful weekend, and thanks for listening.